Something is breaking. Not on the screens, not in the headlines, but deep inside the machinery that sets prices. Paper silver collapses. Yet physical buyers rush in faster than ever before. That is not speculation. That is behavior. When demand surges after a smash, when vaults move quietly, when rules tighten instead of relaxing, the market is no longer telling a story. It is issuing a warning. Because historically, when Wall Street panics, it is never about price. It is about control. And the most dangerous part is this. The real signal never appears where everyone is looking. Welcome to Boring Currency Reports. If you've lived long enough to see cycles repeat, if you value calm thinking over loud promises, then this channel was built for you. Consider subscribing, not for excitement, but so you don't miss the signals others ignore. And before we begin, tell us in the comments, where in the world are you watching from today? They noticed it first as a contradiction. On trading screens, silver prices were falling sharply. Red numbers flashed across terminals. Commentators explained it away as volatility, positioning, or routine market behavior. On the surface, it looked familiar. Another hard day for a commodity caught in a turbulent macro environment. But beneath that surface, something unusual was happening. Something that did not fit the script. While the paper price of silver was being pushed down, physical demand was accelerating, not slowly, not cautiously, but aggressively. In normal markets, falling prices signal fear. Buyers hesitate. Sellers dominate. Liquidity dries up as participants wait for stability. That is how textbooks describe rational behavior. Yet this time, the opposite occurred. As the price dropped, buyers stepped forward with urgency. Dealers reported record activity. Inventories moved faster than expected. The public response was not panic, it was conviction. That divergence matters. Markets are not driven by price alone. They are driven by behavior. And when behavior breaks from expectation, experienced observers pay attention, because anomalies often appear before larger structural shifts. They are early warnings, not conclusions. The key question was not whether silver was up or down that day. The question was why buyers were willing to act decisively when the screen suggested weakness. To understand that, one has to separate two different markets that are often treated as one. There is the paper market, where contracts are traded, leveraged, hedged, and closed without metal ever changing hands. And then there is the physical market, where real silver must be located, paid for, moved, stored, and delivered. These two markets are linked, but they do not always speak with the same voice. On this day, they were saying very different things. The paper market was communicating pressure. The physical market was communicating demand. That is not a coincidence, it is a signal. Experienced capital understands that paper prices can move for reasons that have little to do with supply or demand. Forced selling, margin changes, algorithmic flows, and liquidity gaps can all push prices lower even when fundamentals remain unchanged. These moves feel dramatic, but they are often mechanical. They reflect how the system processes risk, not how participants value the underlying asset. Physical buyers tend to behave differently. They are slower, more deliberate, and more sensitive to long-term conditions. When they accelerate during price weakness, it suggests they see value where others see risk. It suggests preparation rather than speculation. This is why the surge in demand after the price drop drew attention. It was not driven by emotion or excitement. It was driven by interpretation. Buyers were not reacting to the headline. They were reacting to what the headline failed to explain. They understood that price is not always the same as cost, and it is not always the same as availability. In commodities, availability matters more than price over time. A low price means little if supply cannot respond. And in silver, supply does not respond quickly. Much of global silver production is a byproduct of other mining activities. Output depends on decisions made for copper, zinc, and lead, not silver itself. This creates rigidity. Demand can rise without supply adjusting in parallel. That structural reality does not change because a chart turns red. The buyers who stepped in understood this. They were not buying because they expected an immediate rebound. They were buying because they believed the price move was disconnected from the real conditions underneath. In their view, the drop represented opportunity created by paper mechanics, not a deterioration in value. This is where many observers make a mistake. They assume demand surges mean shortage. That is not always true. What demand surges really indicate is confidence. Confidence that the long-term equation remains intact. Confidence that the asset still performs a role others may underestimate. Silver occupies an uncomfortable position in the economic system. It is both an industrial input and a monetary metal. It is used quietly in infrastructure, technology, and energy systems, while also functioning as a store of value for those who distrust paper promises. That dual identity makes it difficult to frame, and even more difficult to control through narrative. When price falls and demand rises at the same time, it exposes that tension. For decision makers, this moment is not about predicting the next move. It is about recognizing the shift in behavior. When markets stop responding as expected, they are adjusting to something new. That adjustment often happens silently before it becomes visible. What unfolded during this price drop was not chaos. It was selection. Weak hands exited through forced mechanisms. Stronger hands entered quietly, guided by structure rather than sentiment. That is how transitions begin. And it is why this moment deserves attention, not as a signal of immediate crisis, but as evidence that the story being told on screens is no longer sufficient. The real narrative is forming elsewhere, slowly, unevenly, and out of public view. They did not need to guess what caused the sudden drop in price. The mechanism was visible to anyone who understood how modern markets function. What confused most observers was not how the price fell, but why it fell so quickly while real-world demand was moving in the opposite direction. To understand that, one has to look away from silver itself and toward the system that prices it. The paper market is not designed to reflect physical reality in real time. It is designed to manage risk, transfer exposure, and provide liquidity. That difference matters. Futures contracts are promises, not objects. They can be created, traded, and closed in volumes that would be impossible in the physical world. This gives the paper market speed and scale, but it also introduces distortion. When volatility rises, the system reacts automatically. Clearinghouses raise margin requirements. Brokers reduce leverage. Algorithms adjust exposure. None of these actions are emotional. They are procedural, but their combined effect can be violent. Traders who cannot meet new margin requirements are forced to sell. Positions are closed not because the thesis changed, but because the rules did. This is how prices can fall rapidly without new information. In this environment, selling becomes contagious. One forced liquidation triggers another. Liquidity thins out. Prices move faster than expected because there are fewer buyers willing or able to step in on the paper side. The move feeds on itself until pressure eases or intervention occurs. This is not manipulation in the dramatic sense. It is structural behavior. The important point is that none of this requires physical silver to change hands. A large amount of price movement can occur without a single ounce being delivered. The market is responding to risk controls, not supply shortages or demand collapses. That distinction is critical for serious observers. Because while the paper market was busy reducing exposure, the physical market was not operating under the same constraints. Physical buyers were not subject to margin calls. They were not forced to sell. They were making allocation decisions based on availability, cost, and long-term use. This is where the divergence widened. Wall Street's concern was not about silver as a metal. It was about volatility as a threat to balance sheets. Rapid price movement increases the risk of default within the system. When that risk rises, institutions prioritize survival over opportunity. From the outside, this looks like panic. In reality, it is stress management, but stress leaves fingerprints. When margins rise suddenly, it signals that the system is uncomfortable with the speed and size of recent moves. When trading rules tighten during volatility, it signals fear of cascading failures. These are not signs of confidence. They are signs of fragility. The paper market is extremely efficient when conditions are stable, but under stress, it becomes defensive. It seeks to reduce open risk as quickly as possible, even if that creates distortions. This is why prices can overshoot in both directions. For physical buyers watching from the outside, this behavior can look like opportunity. They understand that the paper market often exaggerates moves. They understand that forced selling does not equal informed selling. And they understand that when institutions retreat, gaps can form between price and value. This is why the physical response matters more than the paper move. The surge in buying during the price drop was not driven by optimism. It was driven by interpretation. Buyers interpreted the paper sell-off as mechanical rather than fundamental. They saw a system adjusting risk, not a market rejecting silver. This interpretation is not new. It appears repeatedly during periods of transition. In past cycles, similar patterns emerged before major repricing events, not because demand suddenly exploded overnight, but because confidence in the pricing mechanism weakened. When participants begin to doubt whether the screen price reflects real conditions, behavior changes. They stop waiting for confirmation. They act when dislocations appear, and they prioritize control over convenience. This is especially true for businesses and long-term planners. Manufacturers, infrastructure developers, and supply chain managers cannot afford to rely on volatile paper signals alone. They think in terms of continuity. When prices swing violently, their response is not to speculate, but to secure inputs. That mindset does not show up immediately in price charts. It shows up in purchasing behavior. The paper market, meanwhile, continues to do what it is designed to do. It compresses risk. It transfers exposure. It protects the system from sudden shocks. But in doing so, it can create outcomes that appear disconnected from reality. This is not a failure. It is a feature. The danger arises when observers mistake this feature for truth. Because if decisions are made solely on paper signals, they miss the deeper shift. They miss the moment when confidence quietly migrates away from abstraction and toward substance. Part 2 reveals that the price drop was not a verdict on silver. It was a stress response within a leverage system, and stress responses are temporary. What matters more is what participants do after the stress. The paper market sought safety. The physical market sought ownership. That difference is not philosophical. It is strategic, and it sets the stage for what comes next. They were not announced on television, they did not trend on social media, and they did not arrive as a single dramatic event. Instead, the signals appeared quietly, in places most people never look. While attention remained fixed on charts and commentary, movement was taking place inside the physical market. Not fast enough to feel like a crisis, not loud enough to feel like a headline, but consistent enough to matter. This is how structural shifts usually begin. The first clue came from premiums. In certain regions, buyers were paying noticeably more than the quoted paper price to secure real silver. This was not a temporary surcharge caused by logistics or taxes alone. The premium persisted. And persistence is what turns noise into signal. Premiums exist for a simple reason. Someone wants the metal badly enough to pay extra. When that behavior spreads across regions, it tells a story that the global price does not capture. Paper markets assume geography does not matter. Physical markets prove that it does. Silver is not evenly distributed. It moves where incentives are strongest. When premiums rise in one region, arbitrage begins. Metal flows toward the higher price. Supply elsewhere tightens quietly, without a single alarm being triggered. This is not scarcity, it is reallocation. But reallocation changes balance. At the same time, reports began to show changes in vault activity. Metal was being withdrawn, reclassified, or shifted between categories. On their own, these movements were not alarming. Warehouses operate continuously. Inventory changes are normal. What matters is context. These movements occur during heightened volatility, rising demand, and tightening rules. In that environment, inventory behavior carries more meaning. When conditions are comfortable, no one watches the vaults. When conditions become uncertain, every ounce gains relevance. The system that supports futures markets depends on confidence. Contracts represent claims. Those claims are backed by inventory structures designed to function smoothly as long as most participants remain indifferent to delivery. The moment interest in delivery rises, attention shifts to the plumbing. This does not mean the system is failing. It means it is being tested. Experienced observers understand this distinction. They do not assume collapse, they watch strain. Strain appears as delays, tighter rules, shifting classifications, and increased attention to inventory. It appears as risk management becoming more visible, and visibility is the opposite of confidence. Another layer of evidence came from regional divergence. While prices in one market suggested weakness, pricing elsewhere suggested urgency. This is not unusual during transitions. Global markets rarely move in perfect unison, but when divergence persists, it becomes difficult to ignore. The paper price presents a single number. The physical market presents many prices. Those prices reflect real decisions made under real constraints. When they diverge meaningfully, it signals disagreement about value. This disagreement is not emotional. It is practical. Physical buyers face different risks than paper traders. They care about lead times, supply continuity, and reliability. A low price is irrelevant if metal cannot be secured when needed. That is why premiums matter more than spot prices to certain participants. They are paying for certainty. What makes this period unique is not the existence of these signals, but their alignment. Rising premiums, persistent demand, and visible inventory movement occurred simultaneously with aggressive paper volatility. That combination is rare. It suggests that the physical market is not reacting to price, but to conditions. Another overlooked signal is silence. During moments of true excess, markets are loud, promises are made, predictions become extreme. During this phase, the physical market remained relatively quiet. There was no celebration, no grand claims, just steady action. That restraint is telling. It indicates accumulation rather than speculation. It suggests buyers are not chasing momentum, but securing position. This kind of behavior rarely shows up at tops. It appears during transitions, when uncertainty is high and conviction is uneven. For businesses and long-term planners, these signals matter deeply. They cannot afford to react late. They must read early signs and act before constraints become obvious. By the time headlines acknowledge stress, options are already limited. This is why the physical market deserves attention. It does not speak loudly, it does not move quickly, but it rarely lies. The quiet evidence suggests that confidence in paper pricing as a sole reference is weakening, not collapsing, but thinning. Participants are hedging against abstraction by anchoring to substance. That shift does not guarantee higher prices tomorrow, but it changes the trajectory. Because when enough participants prioritize possession over exposure, the system must adjust. Adjustment can be slow, it can be messy, and it often happens after long periods of apparent calm. Part 3 is not about predicting a breaking point. It is about recognizing accumulation of pressure. Pressure does not announce itself, it builds. And by the time it becomes visible to everyone, it has already done its work. They often speak about silver as if it were optional. In policy discussions, it is grouped with commodities that can be substituted, delayed, or redesigned around. In market commentary, it is treated as a speculative instrument, rising and falling with sentiment. But this framing ignores the role silver actually plays inside the modern economy. Silver is not a discretionary input. It is a functional one. Across multiple industries, silver is used not because it is fashionable, but because it works. Its conductivity, durability, and reliability make it difficult to replace without sacrificing performance. This reality shapes demand in ways that price alone cannot easily influence. Electrification is the most visible example. As power grids expand, renewable energy systems scale, and digital infrastructure grows, silver remains embedded in the system. Solar panels rely on silver paste to move electrons efficiently. Electric vehicles depend on complex electrical systems that require high-performance materials. Data centers, sensors, and advanced electronics all incorporate silver in small but critical quantities. These uses are not easily redesigned. When prices fluctuate, manufacturers do not immediately reduce consumption. The cost of silver is often a small fraction of the total product cost, while the cost of failure is high. This creates inelastic demand. Consumption continues even when prices rise, and it does not disappear when prices fall. This is why demand trends matter more than daily charts. Industrial planning operates on long timelines. Facilities are built years in advance. Supply contracts are negotiated with continuity in mind. Sudden price moves are absorbed, not acted upon. What matters is availability and reliability. This is where the supply side becomes critical. Unlike many commodities, silver production is constrained by structure. A significant portion of global silver supply comes as a byproduct of mining for other metals. Decisions to increase output are driven by copper, zinc, or lead economics, not silver prices. This creates a delay. Even if silver prices rise sharply, supply cannot respond quickly. New projects take years to develop. Existing operations are optimized for other outputs. This mismatch between demand flexibility and supply rigidity creates long-term pressure. It also creates vulnerability. When industrial demand rises steadily while supply responds slowly, inventories absorb the difference. Over time, this draws down buffers. The process is gradual, almost invisible. But once buffers thin, the system becomes sensitive to disruption. This is not speculation. It is logistics. In such environments, volatility in paper markets becomes less relevant. Industrial users are not trading contracts. They are securing materials. When uncertainty increases, they do not wait for confirmation. They build redundancy. This behavior does not require panic. It requires prudence. The dual role of silver complicates matters further. It is not just an industrial input. It also functions as a monetary asset. This attracts investment demand during periods of financial uncertainty. The two demand streams are driven by different motivations, but they converge on the same material. That convergence is difficult to manage. When policymakers attempt to frame silver as purely industrial, monetary demand increases. When it is framed as purely monetary, industrial demand persists. Either narrative leaves one side unaddressed. This is why silver resists simple categorization. For entrepreneurs and business leaders, this has practical implications. Input costs may not follow predictable cycles. Supply assurances may weaken without warning. Hedging strategies based solely on paper prices may fail to reflect real exposure. The lesson is not that silver is about to run out. The lesson is that its role in the economy is changing. It is moving from a background material to a strategic consideration. Strategic materials behave differently. They are accumulated quietly. They are protected indirectly. And their pricing becomes less transparent as non-market considerations enter the equation. This does not require government intervention to begin. It begins with recognition. Once industries and institutions acknowledge dependence, behavior changes. Contracts become longer, inventories grow, flexibility decreases. Part 4 highlights that silver's importance is not cyclical. It is structural. Price volatility may obscure this fact in the short term, but structure asserts itself over time, and when structure and narrative diverge, structure usually wins. This is why the current environment deserves attention. Not because of dramatic forecasts, but because of quiet constraints forming beneath the surface. The market is not mispricing silver because it is irrational. It is struggling to price something that no longer fits its old category, and that struggle is far from resolved. They did not announce it as a silver story. The language was careful, broader, safer. It focused on critical materials, resilience, and supply security. But beneath the policy language was a shift that experienced observers recognized immediately. Governments were beginning to treat inputs not as commodities, but as strategic dependencies. This distinction changes everything. When states rely on open markets, price is the primary signal. When states lose confidence in those markets, behavior changes. They stop trusting just-in-time delivery. They stop assuming stability, and they begin preparing for disruption. Strategic stockpiling is not about speculation. It is about insurance. Historically, governments only intervene indirectly in markets when continuity matters more than cost. Energy, food, and defense materials fall into this category. The moment a material is discussed in this context, it has crossed a threshold. It is no longer just an asset. It is infrastructure. Silver occupies an uncomfortable position in this transition. It is rarely named directly in policy headlines, yet it sits inside many of the systems policymakers care about most. Energy transition plans, digital infrastructure, defense electronics, and medical technologies all rely on silver in ways that are difficult to substitute. This makes it strategically relevant even when it is not explicitly acknowledged. Governments understand this, but they also understand narrative risk. Explicitly labeling silver as strategic could accelerate behavior they are not prepared to manage. It could draw attention, raise prices, and complicate procurement. So instead, it is folded quietly into broader categories. The policy focus remains diffuse, while the preparation becomes specific. This is a familiar pattern. State behavior rarely moves markets overnight. It alters incentives slowly. It influences regulation, reporting, and access rather than price. Controls appear as rules, not bans. Friction increases subtly. For private capital, this creates a dilemma. When governments enter the equation, markets become less transparent. Signals become harder to interpret. Actions are guided by objectives that are not purely economic. This introduces policy risk, an uncertainty that cannot be modeled easily. Entrepreneurs and businesses feel this first. Regulations tighten, compliance costs rise, supply chains become more complex. What was once a simple purchasing decision becomes a strategic one. This is where silver's dual nature matters again. As an industrial input, it becomes subject to security thinking. As a monetary asset, it attracts attention during financial stress. When both dynamics are active, state interest increases, even if it remains understated. The result is a market that no longer responds only to supply and demand. It responds to priorities. This does not mean confiscation or dramatic intervention. Those narratives are simplistic and often misleading. Modern control mechanisms are more subtle. They involve reporting requirements, export controls, preferential access, and procurement agreements. These tools do not announce themselves as restrictions. They present themselves as safeguards. From the outside, markets still appear free. Prices still move. Trades still occur. But flexibility diminishes. Optionality narrows. This environment rewards preparation over reaction. Those who assume markets will function as they always have may find themselves constrained at the wrong moment. Those who recognize the shift can adapt quietly, adjusting strategies before friction becomes visible. Part 5 is not about fear. It is about realism. When states change how they view a resource, the resource changes how it behaves in markets. Volatility increases. Transparency decreases. Long-term planning becomes more valuable than short-term positioning. This is especially relevant for younger entrepreneurs and business leaders. Many have only known markets where access was assumed and liquidity was abundant. Strategic materials operate under different rules. Silver is moving closer to that category, not because of ideology, not because of conspiracy, but because systems that rely on it are expanding, while supply remains constrained. The state's involvement is not the beginning of the story. It is confirmation that the story has advanced to a new phase, and once that phase begins, markets rarely return to their previous simplicity. The final question is not whether governments will act. They already are. The question is whether capital will recognize the shift before its options narrow further. That question leads directly to what comes next. They are still arguing about price. That is the distraction. While attention remains fixed on short-term moves, the system itself is communicating something far more important. Not through headlines, not through forecasts, but through behavior, friction, and constraint. These are the signals that appear before transitions, not after. Every complex system gives warnings before it changes state. In financial markets, those warnings do not arrive as clear announcements. They arrive as instability in mechanisms that once worked smoothly. Rising volatility, sudden rule changes, diverging prices, increased reliance on intervention rather than trust. All of these are now visible. The silver market is not isolated from the broader economic environment. It is embedded within it. And that environment is under pressure. Debt levels are high. Refinancing costs are rising, fiscal flexibility is narrowing, central banks are forced to balance inflation control against financial stability. There is no easy resolution. When systems face this kind of constraint, they seek control. Control reduces uncertainty, it limits risk. But it also changes incentives. Markets become less about discovery and more about management. This is where silver becomes instructive. The divergence between paper and physical behavior is not a temporary anomaly. It reflects a deeper disagreement about value, access, and trust. Paper markets assume liquidity. Physical markets require delivery. When those assumptions drift apart, friction increases. Friction is not failure, but it precedes it. The surge in physical demand following price weakness was not a vote on short-term direction. It was a response to perceived misalignment. Participants were not betting on a rally. They were positioning against uncertainty. This is a crucial distinction. Speculation seeks profit. Preparation seeks continuity. The current environment is rewarding the latter. Businesses, institutions, and individuals with long-time horizons are adjusting quietly. They are reducing reliance on abstractions and increasing exposure to tangible inputs. This behavior rarely shows up in consensus narratives. Markets tend to explain change after it happens. They rationalize outcomes. They assign causes. But by then, positioning has already shifted. The warning embedded in this moment is not about silver alone. It is about how modern systems behave under strain. When confidence weakens, mechanisms tighten. When mechanisms tighten, flexibility disappears. And when flexibility disappears, volatility becomes structural rather than episodic. For entrepreneurs and decision makers, this matters deeply. Operating in such an environment requires different assumptions. Price stability cannot be taken for granted. Access cannot be assumed. Hedging must consider not just price risk, but availability risk. Timing also changes. Opportunities no longer appear when consensus is comfortable. They appear when systems are adjusting, often uncomfortably. Those moments feel chaotic. They are marked by mixed signals and conflicting narratives. But they are also when long-term positioning is established. This does not mean acting rashly. It means observing carefully. The most common mistake during transitions is overconfidence. Some assume collapse is imminent. Others assume nothing is happening. Both extremes are dangerous. Systems rarely move in straight lines. They stretch, compress, and adapt before they break or reset. The current signals suggest adaptation is underway. Paper markets are defending themselves. Physical markets are asserting importance. States are preparing quietly. None of this points to an immediate outcome. It points to a change in trajectory. That is the warning. It is not a call to panic. It is a call to awareness, to understand that the rules governing yesterday's environment may not apply tomorrow, to recognize that volatility is not noise, it is information. Silver is simply where this tension is most visible, because it sits at the intersection of industry, finance, and policy, because it cannot be easily replaced, and because it exposes the difference between ownership and exposure. In periods of stability, that difference seems trivial. In periods of stress, it becomes decisive. The system is not broken, but it is signaling. Those who listen early are not rewarded with certainty. They are rewarded with options. And in an environment where options are quietly disappearing, that may be the most valuable asset of all. This is not the end of the story. It is the moment before outcomes become obvious. And by the time they are obvious, it will already be too late to prepare.